Okay, thank you very much for the invitation. So a few weeks ago, Long asked me to talk to him in Hanghzou, and with a glass of wine, we said, look, let's write review papers. So that is, let's say something like I really want to do because 2 years ago, I moved from Switzerland, most famous advanced banking development country, back to China. And this review paper, which also joined with Injima. And again, we thanks Nen and Zhigu already mentioned a lot of information. I'm going to build up my foundation because thanks again, local academia is a platform between academia and business practitioners. At the beginning, let me start asking one question, which is in the review papers, we always ask ourselves as academia or people in the financial industry. So people always say, how digital finance try to make finance more inclusive? So this is a review paper, we try to answer these questions. For people in these floors, also I don't need to spend too much time to talk about barriers. Number one, information. Information asymmetry, information incomplete, make a lot of people cannot enjoy the modern finance service. Number two, bank account accessibilities. So also discrimination, something also like bank account, open banking, or all other things. More importantly, recent literature, we talk about behavior finance, we talk about financial literacy, behavior bias, attention constraint, etc., etc. More important, also institutions, so-called enforcement. So before us, we have four very difficult barriers to provide the financial service to low-income countries, especially from Brazil and China, as a lot of remote area. So in this talk, I want to highlight one thing because whole review papers, we're going to summarize two very important components to provide so-called digital finance to inclusive finance, which is start from digital payment. Okay? Digital payment is a harbor to access the digital finance. From digital payment, they will have a digital finance. From digital finance, we're going to provide financial inclusions. So the rest of 18 minutes, I'm going to give two parts. Number one, I will share some study fact we learn from practitioners, okay? Then we're going to provide some, study, some of academic application to think about it, why and how digital finance is going to provide financial inclusions. Okay, let me start it. So that's a recent paper we're working with the BIS, so we try to study what's different between China, why China become leapfrog in terms of digital finance. So one major indicators, very important for the policymaker, is the payment, digital payment. If you look at left-hand panel, in my left-hand panels, which is in red bar, represent so mobile payment over GDPs. You can see the US, roughly 0.5%. And UK, which has studies, 0.1%. Mobile payment relative GDPs for those advanced country or emerging market globally, compared to China, which is the left-hand panels, guess what? The blue bars, okay? More than 15%, 1.5% compared to 0.5%. So mobile payment, digital payment is inroads for us, especially for those financial inclusive population getting into modern finance. So let's summarize what's the major business models. Firstly, from payment, like Alibaba, Amazon, Facebook, runs electronic platforms. You can include social media or e-commerce. Also, networks provide facility to trade and exchange information. Okay? Start from this kind of network, then you have data bypass. They accumulate huge customer data. Okay? That data is not only big data, not only the amount data, different dimension data, more importantly, a lot of behavior data. Okay? Through the most efficient and safer in terms of cost, the harbors, the facility to acquire information within platforms is now digital platforms. Then within the platforms, they provide a lot of financial service. Okay? That's why we always say it's called DNA, data, network, and activity, or ecosystems. So from that, we ask a question. Does this kind of a technology-driven finance service can provide so-called financial inclusions? Okay? That is overall now review paper try to answer through all the literature across different countries, industry, and we're going to share. Number one, In business, Long and local academia summarize the path of digital finance, start from the payment, the QR code payment, through payment, the easily acquired, okay? It's adoption about consumers and information about both sides, demand side and supply side, more important, inclusion. Secondly, based on payment, they have at least two different kind of lending business. Number one, consumer finance. Number two, SME lendings. Finally, they also have a very nice, in terms of inclusive investment, allowed the low-income people to get into the financial service, to enjoy so-called, financial returns, okay? So through this kind of, later I'm going to explain through robot advisor, the platform of fund, key point is going to increase so-called digital age financial literacy and the trust experience, for normal people or for the people, for low-income populations who enjoy the inclusive investment. The key point is inclusion, we already highlight. So those are business practitioners, the daily business, but how we summarize into academic papers. So in this floor, we have a lot of great scholars here. I just highlight a few things, a few papers. Number one, how digital finance reduce information cost. So through QR code, we have Yiping have a fantastic paper about QR code and then financial inclusions. And for SME side, but consumer side, again, local academia have a lot of amazing PhD students, PhD fellows. I see Ouyang's here. Ouyang write a very nice paper. Look at once you use this kind of cashless payments, QR code payment system, it's going to promote consumer finance. And then, we have a lot of series papers about big tech lending, bank lending by Wei Xiong, and Zhigu have a few papers, investment IT, which he just highlighted a little bit. And finally, the former my PhD student, Yadong, write a paper about home buys, information asymmetry, and fintech lending when he was a PhD fellow here. Then how to increase accessibilities. Remember, there's a lot of behavior bias, also discriminations. So a few papers I need to highlight is here again. Zhigu have just mentioned about paper about open banking, data competition, etc. The huge literature try to show digital finance is going to provide, okay, inclusive financial inclusions, reduce is a behavior bias or discriminations to allow low-income population and weak populations getting to a weak group or amount of population getting to enjoy finance service. So due to time, let me just highlight two things. Two implications. Consumer side, or consumer smooth consumption through the platform e-commerce. I think Hanmi have a paper for that. And also, one thing I'm highlighting in the end, if I have time, so-called digital financial literacy through the platforms. And finally, behavior bias. Okay? So we think so far when we talk about consumer side, how about financial institutions? So a lot of digital finance is going to provide financial inclusions through different kind of financial institutions. A few paper about Shangjing paper look at the financial market, and a few paper, the Zhigu paper look at the bankings. Also, very important, look at wealth management. Okay? So if I miss any paper, just please let me know. But on average, we are going to review all the excellent academic papers, try to meet, to understand now business practice. Okay? So within another 5 minutes, I'm going to give an application how academia use academic language to explain the amazing growth in terms of financial inclusion through digital finance. Let me start number one. Number one, we talk about small business lendings. Most literature try to understand why small business cannot grow. Most of the small business, we look at left and the right, small people cannot compete with big guys because either they cannot survive, also the lack of a resort to compete with big guys. Big business, okay? So that is not only Chinese problems. Small business lending is global matters. That's why we will not only review the Chinese literature, in fact, also global literature. If you look at the famous Jeremy Stein paper, they try to study why commercial bank, even in the United States, have a permanent decline in terms of business lending, small business lendings, because they still follow traditional banking models, okay? Loan officer model, one-to-one, it's a loan officer with the client's application models that cannot broadly serve and small business, okay? So this is a challenge for US and for China. So what happened to China? So if you look at sorry, it's something. So we just matching all the bank branch into all the region in China. Because a lot of remote area, rural area cannot access as a follow-way to financial service. However, if you look at the recent survey, the small business, the lack of financings. So the financing need is huge. But for another side, if you look at the lending side, why those small businesses cannot borrow money from the traditional banking service? Because, number one, high risk, high credit risk. So you have a low skill, very opaque income source, no collateral or financial statement. Very hard to access the credit from traditional financial service. Number two, a lot of the credit market is not only in China, the credit market is segmented. Okay? Finally, a lot of, I just showed the map, rural, remote area, the lack of financial service, the lack of, the far away to the bank branch. So questions we're going to answer within the next few slides is, can digital finance help? Digital finance company provide finance service, have two very important advantage. Number one, they have information advantage. Okay. Secondly, they use the machine learning, big data, algorithm base. Okay. Zhigo just mentioned soft information, hard information. They mainly combine soft and hard information together. They provide credit score, so-called hard information, algorithm base. Secondly, as Professor Huang just mentioned, platform externalities. Platform is very important as a distribution channels to the borrower without any traditional collateral, such as housing and cars. And sometimes they don't, especially if you look at the World Bank survey, bank accounts also reference credit scores in emerging market for Brazil, for China. It's not covered everywhere, it's very low, the coverage is very low. That's why digital finance could provide within platforms, as I mentioned before, DNA, data, activities, and the network, okay? And finally, the one thing I'm going to show you, the last part of my presentation is platform might have a low credit risk. As a lender, they can use so-called platform externalities, okay, to make the platform sustainable as well. So bear me a few slides, later also pictures. I'm going to show you guys some real effect about digital finance. Also, how the lender can provide sustainable finance to reduce default risk based on also information advantage and machine learning algorithms and all other future of platforms I'm going to share. Number one, the first case I'm going to share is a recent paper. Some of our experts here already listened many times. Let me do one more time. So this is a big data algorithm based by credit score based in terms of credit access. You can see before, after 480 is the credit scores. Okay, the probability got a credit access jump. Okay, then we compare very similar populations who got credit, who didn't get credit. What happened performance? After 1 month, it's without any control, it's cross-sectionally without any fixed effect. You can see sales growth, transaction growth, both increase. Okay? If you look at the more academic way to prove digital finance can induce firm growth, we're going to run the econometrics. Okay? Okay, you run the data for 2 stages. But the bottom line, we're going to see of all the controls, we do find out very similar. One got a credit line of credit, one didn't got a line of credit. On average, sales growth. Also proxy for customer capital, customer attentions, so-called ratings also increase. Okay, by different kind of very sophisticated, comprehensive statistical exercise. So this is one thing in terms of real effect. Digital finance might provide, okay, real effect to promote financial inclusion, especially for those people, population never enjoy the traditional financial service. Number two, let me summarize. So what's new here? New here is, as we summarize, since platform you have as Professor Huang just mentioned, you have also cheap information acquisition cost, verification cost, and storage cost. And very easy to study, use machine learning, cloud computing, easy to study all those data. Then you know the sales performance, owner's characteristic, how to use credit, and non-sales performance, and the service rating. Overall, digital finance have some advantage over traditional banking platforms, information advantage. Platform as a credit, recycling funds and enforcement advantage. And finally, since Ben cannot come in here, I just presented one of his key ideas. At the 2018, when Ben visited Hanghzou and we have a talk, he always say, look, what's new here in terms of digital finance or fintech? The lending model is very different like previous one. Previous one, you rely on collateral. Now, since we think digital finance platforms, information becomes so cheap, acquisition, verification, and storage, and also study, analyst the cost is verification very small, reduced dramatically. So his key idea, summarized with all my empirical finding, is information as collateral substitute. Okay, so information or as Professor Yiping Huang's paper, data replace collaterals. Okay, that's something in terms of lending side, borrower side. What happened to the lender side? So recent paper with Long and BIS, they have also introduced. They have one very nice way to think about, look at the prediction default risk. If you look at the default risk, the blue bars represent whole China, the bars. So in the top is rural commercial banks, then you have city commercial banks, then you have joint stock commercial banks, then we have digital finance platforms. Before the pandemics, it's much lower than nationalized average, okay? After pandemic, even the increase tiny, they decline. So question is, why? What credit risk model can help the lender to provide sustainable inclusive finance? So that's the project that started, we try to study. So we talked to also experts in this room, and the engineer told me, look, they are very different, like traditional banks. They do ex-ante screening, ex-post, not only monitor, also adjustment, dynamic adjustment. I believe a lot of great series can write a very nice paper about how to this kind of security design, how dynamic adjust it. Why? If you look at data, the red line, the left-hand panel is the probability of default for 30 days. 30-day delinquency rate increase during the pandemics. Then the red line is represent credit admission ratios, which means the more default probabilities, they provide less the new in terms of admission rate in terms of credit. So what's the potential channel? Also, credit admission was lower, it's negatively correlated with predictive default. Okay, why? Two things, very important. Due to time, let me quickly summarize. Number one, real-time adjustment in credit conditions contains the loss. Why we need buffers? We need to worry about the loss. That's why we use the PD model to predict that. Second, and very, very important, as I have to mention his name many times, platforms. Platform externalities. Platform benefit, incentive for borrower to repay, because you not only know they're able to pay by also education, education, offline income, also more importantly, they're willing to pay. Okay? Dynamic, real-time adjustment due to the big data advantage. Okay? So again, a more sophisticated way, use academic language, we run regression, we do find out SME more integrate, online, offline integrate with the platforms, the default's less. Okay? If you're interested, we can discuss all the details after my presentation and during coffee break. So finally, let me summarize. I taught also EMBA, so I use a picture to teach my students. So what's different between banking finance and the fintech, also digital finance? Bank finance need collateral, they suffer a lot of information asymmetry. They cannot provide the finance service to this long tail, non-standard borrower. What happened to big digital finance, fintech? They use big data, use all kind of data to predict, to verify the future cash flows. Okay? And finally, let me conclude. And Long used to ask me to think, what do you think about the future finance since you're back from Switzerland? I think, look, so three things very important. Inclusive, I just mentioned, we write a review. Also very important, scalable. Okay, use machine learning, use algorithm-based lendings, big data lendings that provide non-standard, also scalable finance, or importantly, sustainable finance. So what's the implication between traditional banking and the credit market? That's very important because big data not only the size of data, also different dimension data. We have behavior data, a ton of data, have more information to help us to understand the potential borrower, okay? The population whose lack of financial service, not only lendings, also later if I have time, talk about investment, okay? Second, machine learning. Also, machine learning, algorithm-based, this morning we'll talk a lot in terms of new technology, more efficient, more precisely to predict default, predict the risk, credit risk. Secondly, what's happened to the fintech digital finance lending? Can this kind of system can be sustainable or not? Business model, platform, distribution, customers, okay? The DNA, data, network, activities, that ecosystem, the feedback loop. Secondly, very important, informations. Hard information versus soft information. And very important is within platform, the trust, reputation is a new form of collaterals. Since a lot of people didn't have time to talk about regulation policy today, monetary policy matters. For this platform, digital finance, themselves, they need finance. okay? Any regulation shocks, monetary policy shock, will happen to have impact to the liability side of digital finance providers, okay? Finally, what happened to long-term, can Chinese model can replicate, for example, to Brazil, to Latin American country, to Africa? Very, very important. We need a technology infrastructure like IT and something else. You know better than me. Some expert here, from industry. Also very important. Institutional infrastructures, also very important. The two things together for long-term impact, also global replications. How traditional bank and financial institution collaborate, not only compete with them, very important. They need coordination for platform coordinations, then spill over within online, offline integrations, which is very important for us to deeply understand how inclusive investment is coming. So next slide, advertising for my students who is marketing these years. They try to study what happens by digital financial literacy, improve in terms of portfolio diversification, stock market participations. And one line already say no to me after 0 minutes.
Negative.
Negative, okay. One says if I can't talk about regulation, this is my view in terms of digital finance innovation and regulation. We're back to the industry revolution times. They have this kind of red flag law. So, thank you very much.